Let's start this week with economic data, and we'll spend some time with the jobs report. I've got some extra numbers here on the side. We had both ISMs this week, manufacturing and services. So I've just written the services number in here that matched the same measurement. For manufacturing, PMI 49 is up. Last reading was 48.5, the expectation 48.8. That's not up by a lot. Services at 50.8, that's up as well. This is still in contraction. Services is still in expansion. Looking at the employment index, 45 on manufacturing is down month over month from 46.8. Services at 47.2 is down as well. That implies contraction in both manufacturing and in services. New orders for manufacturing down 46.4, down from 47.6, and for services it is up. And prices up on manufacturing but down on services. Services is the bigger part of the economy. If there is going to be an effect of AI on productivity which drives unit costs down, it'll be on the services side far faster than we'll see it on the manufacturing side. Construction spending negative 0.3%. This is month over month. Last reading was revised down to negative 0.2%. The expectation was negative 2, came in lower. JOLTS, that showed a pretty big jump from 7.4 million openings last month to 7.7, almost 7.8 this month. And job quits from 3.215 to 3.293. More quits, more openings, more quits. It's in the same direction. It's the proper correlation, but I find it interesting that you have employment in both manufacturing. This is for June, manufacturing and services in contraction territory. You have job openings increasing here. Now, mind you, we are backwards looking for May. Yet we are also still in an environment where job openings or job availability for new graduates is the worst it's been in a long time. So, question mark here. Not so much a question mark of why is it that way, but question mark on the data itself. We're getting a lot of data that just doesn't seem to match a lot of anecdotal evidence that's out there. So we have to wonder whether or not the sample sizes or the data collection methods are still capturing what they claim to be capturing. We certainly saw that with ADP and the jobs report. ADP showing negative 33,000 jobs. ADP processes payroll for about 20% of the U.S. Workforce. So its actual payrolls being processed, a more objective number. Unemployment rate, 4.1%. It dipped from 4.2 to 4.1. The expectation was for an increase to 4.3. So that came in a lot better. But when we look at what's going on here, it's because the labor force is shrinking. Average hourly earnings on an annualized basis, 2.68%, well below the 3.5% that the Fed claims is consistent with 2% PCE. The average weekly hours did drop by 0.1. So when we calculate average weekly earnings, because you have an increase in average hourly earnings but a decrease in weekly hours, average weekly earnings actually decreased. So even though you created jobs, and even though you had average hourly earnings increase because of the takeaway on the average weekly hours, the disposable personal income based on average weekly earnings being slightly lower hasn't increased. So it's not a big boost to aggregate demand. Household labor force has dropped 130,000 month over month. This is a big deal here. Look down here. January, at the beginning of the year, the labor force was 170,744. 6 months later, it's 170,380. it has dropped over that period of time. It increased into April, 171. Then you had a big drop into May, 170, and then another drop into June. So the labor force is actually shrinking. Household says 93,000 employed. The jobs created here, if you take out government payrolls, 73,000, that's a big one, by the way. 74,000 by the private sector. That's where you get the 147, 74,000. And the market threw a party. Yay, 74,000. The job market shrinking and the market threw a party. I can understand, a flat day. Maybe not, this is not warranting a sell-off. I mean, it is kind of backwards looking. It is for the month of June. But to throw a party, to say, yay, to me, you're focusing on one number and ignoring all of the others. I would have paid attention to the 74. I would really have paid attention to the 74 when I realized healthcare made up 58,000 of that number. So without healthcare, what do you got? You got maybe 16,000 jobs in the private sector. Government can't employ everybody. And healthcare is really just taking care of, deficits to your health. It's not so much that it's a high productivity vocation, adding more than its own value to GDP. So this is not, I think, indicative of the strength of an economy as much as it's indicative of the health of the people within the economy. There's your measure of the health of the economy, really, 16,000. Less than high school lost 57,000, high school up 288, less than BA up 123, and BA up 67. Full-time, an increase of 437,000, part-time, a decrease of 367, so that's good. 20 to 24, lost 34,000, 25 plus, gaining 97,000. There are your graduates in that cohort there. Diffusion index for all industries, 49.6. That is down from 51.8 down to 49.6. That is contraction. Manufacturing, just manufacturing on its own, 52.1, showing a good jump from 40.3. That was significant contraction. So during the month of June, had a nice recovery. But all industries altogether, 51.8 down to 49.6. That's a big deal. I think the decrease in the size of the labor force is a big deal. I think healthcare making up roughly 90% of all the jobs, all the private sector jobs, is a big deal. But there's a narrative on Wall Street right now, I think, and we'll spend some time on it. We are, I think, leaving the investment, or almost near, I wouldn't say near, middle of the investment boom cycle, but beginning the hype cycle of AI. We'll spend some time looking at what that means. Look at balance of trade. We got this for May. So this is, there it is right here, exports and imports. That's fully reflecting the effect of all the tariffs now. Balance of trade actually got worse. We went from 60.3 billion, that was revised down for the month before, month of April. We're now negative 71.5 billion on the trade deficit, going in the wrong direction. Exports, 290 down to 279. This is dollar value, so it doesn't give us quantity. Somebody alert could probably say, well, wait a minute though. Energy prices were lower month over month. That could account for it. I grant you that this could, since we only have dollar amount, we don't have quantity. It just simply could be what you're exporting has just dropped in price. So if you're exporting more raw materials, they tend to have a global price. If they've dropped in price, well, you may have the same quantity going out, but registering a lower dollar amount. For imports, 350.5 billion, 350.8 billion. You could say it doesn't look like tariffs have done much, but we did have a lower US dollar. So if you were importing, let's say $1 million of Canadian goods, it would show a higher dollar amount because of the lower US dollar. So let's say that during the month of April, you had roughly about 71.5 cents. So you could say, well, for every million of Canadian, you're really importing 715,000 US dollars. If the quantity stayed the same, let's say it's the same stuff coming in, you haven't changed anything, nothing has changed, the same stuff coming in, but you're now at 73, you're now importing $730,000. So a lower US dollar, if your quantity remains the same, should result in a higher import number. That the import number is the same on a lower US dollar suggests that lower quantity is coming in, or that the quantity coming in is coming in at a lower price but a higher exchange rate. Don't really have that granular detail. End result, though, is that the trade balance is worse than what it was the month before. We had a short week last week. We ended on the 3rd, not the 4th. The 4th was, and we ended 1 o'clock on the 3rd. Futures continued to trade. When we got into Friday, futures, S&P futures were down 40 points, and a lot of the rate cut that was priced out in Fed funds futures after the jobs report, I don't know why. Again, I don't know why. If you account for the government jobs and the healthcare jobs, the economy really only produced 16,000 at very low increase in average hourly earnings and a decrease in the average work week. Don't know. Again, I don't know why the party. But the next day, futures continued to trade. It priced back in some of that. Now, what I have here is the Fed funds price term structure as of the 3rd. It continued to trade. The futures did continue to trade on the 4th, although they're not priced in here. So everything I'm showing you is as of the end of the 3rd, but bond futures on Friday did rebound. So yields over here as of the 3rd were this, but as of the 4th, if we could account or extrapolate from the futures price where the yield would be, it would be lower. Let's just keep that in mind. How we open today, I don't know. Trump did on Friday, as the markets were closed, say reciprocal tariffs are going to happen. Some countries as high as 70%. And I did say that we do have to switch from the taco trade to the ego trade because he was called a chicken. Well, he's going to show everybody he's not a chicken now. So now it's pretty much cemented in the idea that he's probably not going to chicken out on this one. So the market started pricing some of that in, or at least the futures market started pricing some of that in Friday. How we're going to open tonight, I don't know. I have to admit at this point in time that I am at a loss for analyzing this market. Fundamentally, the numbers, if we look at the economy, if we look at what is justified for price, if we look at it based on justified by the fundamentals, I've been on the right track on the fundamentals, but the price just refuses to go along with it. We have this market where, what matters is not the fundamentals. And I do have a screen coming up where I've listed what really matters for this market. We'll look at that when I get to the S&P. But yields and rates, if we look at money market rates, all up, and yields all up. The 2-year up by 15 basis points, basically pricing out the better part, 60%, the better part here of a rate cut. And I do think this is wrong. We were at almost a 20% probability of a 25 basis point cut. That's almost all gone, 4.7%. This is July. I do think that this jobs report doesn't pull back from a rate cut. I think it leans into a rate cut. If anything, it should add to the probability of a rate cut. Once you account for all those government jobs, which were at the state and local level, and healthcare, the economy itself. Come on. I guess I'm the only one. I don't know. I didn't understand Thursday's move at all. I was watching and saying, okay, well, I think it's time to give up on certain trades, and we'll talk about that a little later. 95% here. I think this is completely wrong. We get the minutes in 3 days from the last meeting. I think that'll still be interesting. Reverse repo 214, reserves 3.25 trillion. Week over week TLT lost 0.48. SPY just doesn't care. 1.72%. Just as a sign of, not caring. Tesla reported, I think, their worst drop in sales and rallied. Yay! Worst drop in sales. Let's rally because, of course, it's not a car company. But we are waiting for the car company results to determine whether or not we want to treat it as a car company today or not. Dollar index down 0.61. This, I got a big question mark on this. If foreign money is coming into this market to buy the market because of American exceptionalism, you can start to see why you're getting this, but it would also push up the value of the dollar because you got to sell your euros, or you got to sell your CAD, or you got to sell your Aussie to buy US dollars, to buy US assets. That would be pushing up the price. So this one here, there is a leak somewhere because the value of the dollar is going down, which means there is more selling of the US dollar than there's buying. That's basically what it comes down to. We can keep analyzing backwards of, well, why is there more selling than buying, and why is this action happening, etc. But in the end, the most proximate cause of the DXY dropping is there is more selling than buying. If there's more selling of the dollar than buying, that suggests that, value is leaving the US dollar, not entering the US dollar. So this has got to be more purely domestic in this sense. It doesn't sit very well. I can't figure that one out. It's a puzzle. Duration this week, be careful, right? Wednesday, 10-year auction. Thursday, we have a 30-year auction. And the big, beautiful bill has now passed, and Elon Musk has now officially begun a third political party called the American Party, which I think is a bad name for it, but there it is. Does sentiment, and it seems fairly clear that the deficit is going to stay where it is, if not get worse, and the debt is only going to get worse at this point. And I don't know that it would have been any different under any other government, under any other president. I don't think it would have been any different at all. This is just the nature of democratic politics, is that you must buy your next election with deficit spending. It's about power and access to power. It's not about the health of the country anymore. It's not about you. It's about me. And this is what we have. Democracy is truly broken, I think. Very little Fed speak this week. Looking at our inversions, the 3-month to 10-year is still inverted. If we look at the 3-month to the 2-year, just to see what the market is pricing in, because the 2-year tends to lead by about 50 basis points. We do have roughly about 50 basis points in there, so the 2-year kind of is in the right place. It's leading by 50, but suggesting that there are rate cuts ahead, not rate increases, so that's a good thing. That could be supportive of equity prices. A lower US dollar, by the way, is also supportive of US equity prices, and we have had the US dollar dropping over time. Looking at Fed Funds Futures Q3, less than one rate cut in here. I seem to think July and September make sense. 2 rate cuts. The market is sort of thinking, no, it's going to be September. Goldman Sachs is sort of suggesting the same thing, saying forget July, look at September. And if you get September, you get 1 rate cut with an effective federal funds rate of 4.33. If you get a rate cut, that would put the October Fed funds futures at 95.92. We're at 95.86. So if you are in the one rate cut camp, there is money to be made on the futures. If you get two, that's a nice big gain on this one. For Q4, 35. So still agreeing with the SEP, 2 rate cuts this year. By the end of the year, this is the January Fed funds futures 96.21, pricing in 54 basis points. If you get 2 rate cuts, then this is overvalued. This is 96.17 is exactly 2 rate cuts. I think anything under 95.92 is a buy on the October Fed funds futures. I think anything under 96.17 is a buy, because I think at a minimum you will get the conservative stance of the FOMC of 1 rate cut by the end of September, 1 more by the end of the year. Q1 pricing in 1 more rate cut. So over the next 6 meetings, 3 and 6, if we go to next October, 119 in 10, that's roughly about 5 and 10. So whether you look at the next 6 meetings or the next 10 meetings, the market is pricing in a cut with a hold, a cut with a hold, a cut with a hold. That half of them will be live, the other half will be hold. Seems to be a decent enough pace. Let's have a look at real rates. All increased except the 30-year is flat. Small little moves. This to me seems rather puzzling. But if we assume that nominal yields are traded in their particular market and tips are traded in their particular market, then the break-even rate is really just an artifact of positioning and really probably has no information content in there. Still, I don't know what information was out there that would suggest that break-even should be higher, but here we are. As far as credit risky bonds, all of them paying less for the amount of risk that you take on. So you're being rewarded less. Even the triple C contraction of 24 basis points. Mortgage rate 6.67, down 10 basis points from 6.77 to 6.67. So that's starting to look a little bit better once you start pushing more down towards 6%. Housing market activity, mortgage activity and housing market activity pick up. This is a good sign for the housing market. But the continuation of this trend really requires the 10-year to continue dropping, with the action that we had on Thursday, with the market saying, oh my God, look how strong the jobs market is. No rate cuts for the yields to go up. And we still haven't seen what the effect of the big beautiful bill. I just can't say that with any kind of seriousness. The big beautiful bill, who would do that? Anyways, here we are. We haven't seen the impact that that's going to have on yields on the long end of the curve, because I think I agree with the analysis is that this is going to increase deficits and it is going to add to the debt. And by the end of this administration's term, if the debt isn't 3, 4, 5 trillion higher, I would be surprised. I don't think it'll be lower. It will be higher. The question is it going to be 3 trillion, 4 trillion, 5 trillion? But we're still on the same path. It wouldn't surprise me if long yields just didn't go along for the ride and said, okay, well, the 10-year is going to go back to 4.5, 4.6. Which means this is going to start moving up again. Okay, I'm going to incorporate perplexity into the market outlooks. I no longer Google search and have to click on multiple link after multiple link. All of my searches now, I use perplexity. Apple is considering buying perplexity, something like 35 billion. That's nothing compared to their market cap. And since they don't have a dog in this fight, I think they should. I perplexity everything. I no longer bother with the Google search. When you use a Google search, I get link after link after link. Then I have to make my notes and I make a screen. But when I'm using perplexity, I get this output and I think, okay, I'll make my screen. I think, but why make your screen? Here is your screen. You're done. So I kind of like this. So I asked, did Trump announce reciprocal tariffs beginning July 9th based on public statements over the last few weeks? Tell me more about this. Nice simple prompt. And it gives you all of the sources that it used. You can click here and get a list of all the sources, and here they are listed all across the top. So normally I'd have to click on each one of these and read each one, because each one would have one little piece of information that another one would have, or a different interpretation of it. So you'd have to click on all of these and see over here 9 more. So you've got maybe 15 different websites that I didn't have to read. So let's see what we have. Key details. The tariff rates and scopes. New tariffs will range from 10% to as high as 70% for some countries. Stated about 100 countries are likely to receive the baseline 10% rate, but for those without agreements, tariffs could be much steeper, potentially 60 or 70. In some cases, I don't think he's got agreements with 100 countries. He throws out numbers, just throw out numbers. I don't believe much of what he says. I think the reality behind the scenes is there are no deals. If it were me and I were a country negotiating with him, I'd be making the very real calculation that in 18 months this guy's going to lose the House. None of this is going to matter. All I really need to do is wait him out. He needs a victory. The longer I wait him out, the better arrangement I'm going to get, just so that he can stand up and say we have a deal, and he'll claim victory on that. If we scroll down here, baseline 100 plus countries, this is really just taking him at his word here. 10%. That gives you some of the other ones. Cambodia 49, no deal is reached. It's just reverting back to the original reciprocal tariff. Laos 48, Madagascar, Japan 24 to 35, European Union 20 to 50, some countries up to 70. Implementation timeline. Letters will go out to 10 to 12 countries at a time starting Monday. In a digital world, who's writing letters, and why 10 to 12? I mean, it's a digital world, let everybody know. That doesn't seem to make any sense to me, but okay. Tariffs set August 1st. Administration has reached preliminary deals with some major partners. Remember, 90 deals in 90 days. Let's count them. China, well, that's not really a deal. That's just they sat down and agreed to what they agreed to previously. Anyways, okay. The UK, again, that's not a trade deal. That's just an appeasement to get on Trump's good side, saying that we agree to meet over the next 2 years to see if we can agree on a trade deal. And Vietnam, again, not a trade deal. So what do we got? 1, if we take them as 2, 3 deals, and that's a long ways from 90. At least, it's been a long time since I've had to use my basic arithmetic, but 3 and 9, yeah, it's a long way from 90. Other key economies, Japan, European Union have not finalized agreements, could face higher tariffs. Approach and rationale, Trump has emphasized a take it or leave it stance. That's not the way you negotiate. There is negotiation, and then there's a shakedown. Trump does the shakedown, right? See what falls out of your pockets and says, okay, well, that's more than what we had. Little room for further negotiation once letters are sent. He claims the tariffs are intended to level the playing field and boost domestic industry by making foreign goods more expensive. The lower U.S. dollar is doing that on its own. He's not wrong in saying that tariffs will make foreign goods more expensive. That's almost an admission that it is Americans who pay the tariffs, not other countries that pay the tariffs, but Americans pay the tariff. I was listening to Counting the Cost. It's this show on Al Jazeera. It's on YouTube. And they were looking at the effect of this bill. And one person they had on was talking about the cuts to Medicare and Medicaid, and saying that some people are for the in terms of the deficit are paying that this is a true cost on American people. And my sort of internal answer to that was the whole debt and deficit is a cost on the American people. Who else is going to pay for it? You can't make the Japanese pay for it. Stick tariffs on them. The Japanese don't pay the tariffs. The Americans do. You gotta get it from them somewhere. I've been saying this for years. Every single penny a government spends has to come from you somewhere. It has to come from you somewhere, whether it's higher taxes, different taxes, new taxes, or less services. It's gotta come from you somewhere. So to say that American people are going to pay for this is like, well, duh. If you're in a restaurant and you order a meal, it would be like me leaning over you saying, you know, you got to pay for that, right? Well, it's, yeah, right? You know, you got to pay for it, right? Economic and political context. The announcement comes amid positive economic indicators in the U.S., such as strong job growth, stable inflation. Trump is cited to bolster his position, and this is what I've said before, with the market rallying, it gives him permission to stick to his position even more. That with markets hitting all-time highs, the idea that Trump will chicken out, that there'll be no tariffs, is ridiculous. This gives him permission, because he can say, look what I've done. Look at all the tariffs that are in place right now, and markets hitting all-time highs. The economy's creating jobs. Inflation is non-existent. It can handle more, and more it will. Critics warn that tariffs could raise consumer prices and disrupt global supply chains. Well, it hasn't so far. I mean, it hasn't. And sure, tariffs could, but the countervailing force is AI. That is deflationary. So yeah, some things can be inflationary, some things can be deflationary, but just to take one. So I sort of agree with this, is that, look, you've got these tariffs in place and everything seems to be okay. You could probably do more. Besides, you need more revenue anyways, and the tariff really is a tax on American citizens, of which you gotta tax them anyways. You gotta get that money out of them anyways. Why not put a tariff on? Sure. Uncertainty and reactions. There's still uncertainty about which countries face the highest rates and whether the administration might extend the negotiation period for some partners. Some officials have hinted at possible extensions, but Trump has publicly ruled out pushing the deadline further. He's not a chicken. He will show you that. Well, if they're sending these out Monday, we should get some indication of which countries received it, right? Can't do this in private. And the countries that receive it will probably say something. Somebody somewhere will say, well, we received this. This is what this means. So every day next week, we should get, if it's 10 to 12 a day, we should get 10 to 12 news feeds every single day about this. So let's make sure we're careful next week about the level of the tariffs. This was said on Friday. All I have to go on was what Bitcoin did, because it is a risk barometer, and what futures did. S&P futures pulled back 40 points, and Bitcoin did drop by about $2,000. How we open tonight, I don't know. It's a wild card. Let's stay with perplexity a little bit. In Canada, July 4th was not a holiday. We were open, and the REIT sector had a beautiful day because we have another potential takeout in the REIT space. Earlier in the year, I had mentioned that the valuations in the REIT space were very low. Some of these REITs typically trade at discounts to their net asset value, but in the first couple of months, they were trading at really deep discounts to their net asset value. We saw InterRent already accept an offer or have an offer, and they do have a go shop period. I don't know that they're going to get much out of it. H&R Real Estate has confirmed it is conducting a strategic review after receiving an unsolicited expression of interest from an undisclosed party. In response, the board established a special committee of independent trustees to evaluate this and additional proposals. The special committee is currently in discussions regarding non-binding offers from multiple interested parties. H&R was such a great holding pre-pandemic. It pretty much ranged between $20 and $24, and every time it got down to 20, it was almost an automatic buy because it found its way back up to 24 and paid a dividend along the way. Post-pandemic, they split into two. So I was holding it. You got shares of HR and you got shares of PMX, Primaris REIT. So obviously HR's price had dropped. I think it was like 16, dropped to 12 after that carve out. No decisions have been made about whether to proceed with any transaction. No certainty that the process will result in a deal. Announcement of this review led to more than a 10% increase in H&R units price. which reached 12.16 in trading July 4th, though this remains well below the 25 plus level seen in 2010s. The 25 is including Primaris. So it's not as if, well, it's 12.16, it was 25. Well, you have to add Primaris back in to see where you would be. And if you did, you'd probably be somewhere around 16. Well, actually, they've increased in price. You'd be somewhere around 17. Manages a diversified portfolio of residential, industrial, office, and retail properties across Canada and the U.S. Total assets is approximately $10.5 billion as of March 31st. Because of that, this is now the second bit of activity. Well, not that anything has happened here, but it's the second story in the REIT space in Canada. And again, most of these REITs right now are trading at such significant discounts to the net asset value. It would not surprise me if you have, over the course of this year, 3 or 4 more deals or announcements of deals. Okay, here I'm going to spend some time talking about a potential hype cycle in AI. And we do have some precedent for this. We do have 1999 that we can look at. Let's start with the technology S-curve. All technologies follow this pattern where you have a long period of almost nothing going on because there is some technological or some economic limitation. Quantum computing is sort of here now. Is for the longest time you couldn't get a stable system. Now you do. Now a couple more firms have claimed to do the same thing, but there's still the economic limitation. Then you get to some point where there's some technological or economic breakthrough and investment runs into the space. After a while, the technology is showing rapid improvement, more investment comes in, and you are on this part of the curve. I think we're somewhere around here in the middle to late part of the big investment boom, and the hype cycle is about to start, because what happens is all of this gets extrapolated this way, that it is going to go on forever. And the stories about the future just keep getting bigger and bigger and bigger. That's the hype cycle. When it's no longer the fundamentals on the ground driving price, but it's the story about the future. Because here is the future. Meanwhile, the fundamentals are going to follow this trajectory. When the distance between the hype and reality get too far apart and reality just not coming along, you have the disillusionment phase where you destroy a lot of the value that was created. All technologies follow this pattern. Is while you're progressing along this trajectory, more and more money is investing in that particular technology, and it does have a limit. Now you can look at an industry and say, but the technology in this industry has just gone straight up. How can you say it has an S-curve effect? Is because there is a certain level of technology, and then you have another technology that allows you to get to a higher curve, and then another technology that allows you to get to a higher curve, and a different technology that allows you to get to a higher curve. So there are different waves of technology within an industry. If we look at who the leaders are today in a particular technology space, they were probably companies that didn't exist 20 years ago. And take any technology space now, and the leaders in 20 years will be companies that don't exist today, and the companies that are the leaders today will be gone because they're on a particular type of technological curve or using a particular technological paradigm. The pace of technology within an industry will continue on, but with waves of different technologies, waves of creative destruction. This is take whatever paradigm you want to work in, or whatever technology, I shouldn't say paradigm, whatever technology you want to take. AI is more than just learning models. I'll say it, learning models. I'm trying to say modules. Learning models and reasoning models, robotics, autonomy, image, video, audio, tactile. This is, can we get the it to feel what something feels like. All of these are working on a particular paradigm, and those will all follow the S-curve. And I think we're somewhere right around here as far as what, if you're just looking at a price chart of an index of this type of technology would look like. This is the phase up to the breakthrough, and then once you have that breakthrough, you have investment running in and valuations increasing, and then you have more investment coming in. Once you enter the hype cycle, it just shoots straight up, and then disillusionment sets in, and it comes right back down. It tends to overshoot to the downside as well. It'll overshoot to the upside. It'll overshoot to the downside. Meanwhile, here is the, I think, area where it ends up in. When it undershoots, it does so below its economic or its investment thesis. It tends to find its way back up into there, into this middle range. I said last week that NVIDIA is probably going to go the way of Cisco. But if NVIDIA is here, there's nothing saying that NVIDIA won't get to $300 a share before it crashes down to maybe $60 a share, just to find its way back to where the price happens to be now. The pathway is what's going to matter. The end price, you could probably say NVIDIA is probably correctly priced around 140, 150. But again, during the hype cycle, there's nothing saying it won't get to 300 before it breaks, right? Because hype will go this way. In fact, it might even go exponential, go straight up. You had, I think a couple of months ago, some estimates of unemployment could reach 15, 20%. Then you had somebody say about 50% of white-collar jobs could be eliminated. And a little while after that, Vinod Khosla said 80% of white-collar jobs won't be in existence, and by 2040, people who will work only because they want to, and everyone will pursue everything they want to pursue. It'll be a Garden of Eden, it'll be Valhalla, there'll be no poverty, this will all be eliminated, and the story just keeps getting bigger and bigger, and none of it is true. None of it was true in 1999 either. Some seeds of the future were in the hype cycle, but 26 years later, the world is nowhere near what the hype was in all of the things that were said. And I think it'll probably be the same thing in this case, that much of what is being said will never come to pass. And some of the things that are being said may take 20 years before they actually come into effect. One thing that we can start with is it may be hard to define what these things are, right? Because the technology changes so quickly that from week to week, if you say, well, what is AI? You know, the definition is moving so quickly. We can always start with what they are not. And this is what they will never be. They are not human. They are not intelligent. They are not self-aware, they are not conscious, they are not greater than the sum of their parts. They do not have metacognition, and they do not have emergent properties. So when we talk about intelligence, intelligence is something that emerges at the level of the whole that cannot be decomposed to the parts being the neurons, N-E-N-E-U-R-O-N-S, neurons. And the connections between the neurons, if you're familiar with any of the language here, axons, dendrites, you'll recognize some of that. You can't decompose intelligence to the neuron. It is the collection of all of them together at the level of the whole intelligence emerges. There is no emergent property with these. There is interesting output. There is output that you would look at, say, oh, I didn't expect that. That does not mean that it is emergent. If you say, I didn't expect that, you could trace that output back to its component parts. In other words, you can attribute the output to its component parts. For there to be consciousness, for there to be intelligence and self-awareness, There must be an emergent property at the level of the whole that doesn't decompose. If not, then all it is just the sum total of its parts. So it is not greater than the sum of the parts. So it will never, ever achieve intelligence in the way that we have it. It will never achieve self-awareness. It will never rise up against us and destroy humanity unless it's specifically programmed to do that. And that would be programmed by humans that allows it to do that. And are there humans that would love to do that? Yes, there are. Are there countries that would love to weaponize this? Yes, there are. So if we say that the threat of AI is that it can destroy humanity, that's a threat of nuclear weapons. It can destroy humanity, but it takes a human to do it. It'll take a human to do the same thing over here. They don't have metacognition, which means there's only so much that it can do. Now, I am talking about a particular paradigm. I'm talking about a particular technology that it's on. This may not be true if we move to a different technology, but given where we are today, it does not have any of this, and it's hard for me to accept. And just so that you know, I do have a computer science undergraduate degree that I finished in 2003. It is hard for me to accept that code, no matter how well written it is, no matter what data structure you're using, no matter what transformation mechanism you're using, it's hard for me to see how code running on electrical signals can get an emergent property. When we don't even understand how we achieve an emergent property. If it can't be deconstructed to its parts, how can you go from the part to the whole? You have to hope for something to show up. Scientists have been trying to recreate that kind of life in laboratories for 6, 7, 8 decades, and nothing. That you're going to put zeros and ones combine it with an electrical charge and operate instruction sets and hope that something emerges at the level of the whole. These are emulators. I've called them this before, cognitive domain emulators, and for declarative knowledge, for conceptual knowledge, and for procedural knowledge, which are non-metacognitive forms of knowledge. They will emulate very well. And tasks that have these particular requirements in them are ripe for AI to take them over. The biggest threat to humanity from AI is in reducing the amount of cognitive load we accept and offloading it to the algorithm. That this could make you stupid. I shouldn't use the word stupid. That this could make you cognitively lazy, thereby appearing to be stupid. There we go. Is probably the bigger threat. But social media has done that. Social media rots your mind. Lots of research shows that it actually is pulling apart the fabric and the threads of society. That it does polarize you. It does misinform you. And it does make you lazy. It does reduce your empathy. It does reduce your ability to critically analyze an argument because it pushes you into echo chambers. Social media has already done a lot of this. But the biggest threat here to AI is that people who rely on it and use it will not develop the skills necessary to reach metacognitive knowledge or develop metacognitive skills. This is very different than saying, hey, look, we used to have a lot of horses. Now we have a lot of cars. You're not going to find a lot of people with a lot of knowledge about horses. We've lost a lot of that. But that's a particular knowledge domain that we've lost. We didn't lose the need to use our brains to figure something out, because now we have to figure out how to fix cars. This has the very real potential of saying it's not just domain knowledge you're going to lose, it's the use of the brain in figuring things out that you're going to lose. So yeah, some people will become cognitively lazy and dependent upon this technology for almost all of their thinking. Now, your goal is to make sure you're not one of those. While people take the path of least resistance, you have to make sure that you don't take that path. Let's ask Perplexity to review 1999 for us and see if 1999 followed this same pattern. Because this, if you search for my dissertation, it's called Finding, and you should be able to find it online, Finding Fertile Time. Finding Fertile Time. Just Google that along with my name, and there's a whole chapter on the evolution of technology in that dissertation, where I go into detail about the S-curve, and it is probably one of the most, I don't want to use the word common, persistent observations in the history of technology. Is they all follow an S-curve. Now, some S-curves are very short. Some will be, oh, there you go. Some are very long, where the period of incremental innovation continues on. But while you're on this curve, all innovation is incremental. Radical innovation, truly radical innovation, starts a different curve altogether. And my dissertation, I took the top 1% of highly cited patents over a 20-year period in the US. And I mapped them to the business cycle to see when radical innovation most likely happened. And to define radical innovation, you have to make a difference between incremental and radical. An incremental innovation won't generate a lot of citations. The incremental innovation generally cites the initial innovation or the initial technology. So a technology that has a lot of citations is more likely to be a radical innovation than it is an incremental innovation. So that is what I did here. So you'd have to understand the different waves of technology that these represent. This is, again, the most persistent observation and regularity in the history of technology. And there is no reason to believe that it's going to change, which means it will enter a period of disillusionment. But it will have its hype cycle, which will have something to say about asset values. Okay, back to Perplexity. Here's my prompt. 1999 dot-com theme entered a hype cycle. I think AI is about to enter its hype cycle. In that context, what are the characteristics of a hype cycle for stock markets? And let's see if it matches what we just went through. A technology trigger. A breakthrough or new technology emerges, generating excitement and attracting attention from investors, entrepreneurs, and the media. That was ChatGPT. Remember when that first hit? And it got to like 50 million users in like 2 weeks. It was incredible. Early products or prototypes are showcased, often with limited practical utility but significant perceived potential. And that was the case. When ChatGPT first came out, I used it in the way that I would want some value out of it, and it just wasn't there. You'd ask it some questions, and the answers were like, no, that's not it. So it didn't have any practical utility for me, but the market looked at it as significant perceived potential. Peak of inflated expectations, investor enthusiasm, media coverage escalate rapidly. Well, we saw that, especially after NVIDIA's first quarter, where it really exploded in the data center space. The next quarter, almost every single company was finding a way to say the words AI. AI, we're going to use AI in this, AI in that. Hotel chains were saying we're going to use AI for this and for that. Valuations soar, often detached from underlying fundamentals such as revenue or profit. Companies associated with the hot technology, for example, the .com in 1999, AI today, can attract capital regardless of their actual business prospects. Speculation and FOMO dominate, and traditional valuation metrics often get ignored. Does that sound anything like the environment we're in? I'm sure if you read that, you think, yeah, things like that are happening. I don't think that we're there yet. I think we're at the beginning of this phase. And I think over the next 5 or 6 quarters, the stories about the future are going to be incredible. and the valuations will be dragged along with the story and be dragged further and further from the fundamentals, but we will hit the trough of disillusionment. Reality sets in as many companies fail to deliver on lofty promises. High-profile failures, missed targets, disappointing earnings cause sentiment to reverse. Stock prices fall sharply. Many speculative ventures collapse or are acquired at distressed valuations. Public and investor interest wanes. And then once you get through that, there's the realization, because it overshoots to the other side, there's the realization that, well, wait a minute, there is something here. The internet was like that. It was like, well, hang on a second. The internet does have value. It's just all of these .coms really had no value. You had this massive gold rush, and they're simply just not ready, and they all can't survive. But the technology has value. AI will survive. AI has value, but it's going to enter a hype cycle first. After the washout, the slope of enlightenment, survivors adapt and the technology's real sustainable applications begin to emerge. Investors and businesses become more discerning, focusing on companies with viable business models, proven value creation. Investment returns stabilize and the market becomes less speculative. Plateau of productivity. We don't need to go through that. That's way off in the future. Stock market behavior, mania and blow-off phases, successive waves of exuberance, and sharp corrections can occur as the market tries to price in the future impact of the technology. This is often seen as a series of mini bubbles leading up to market saturation. Speculative metrics. During peaks, investors may focus on unconventional metrics, eyeballs, clicks, or AI mentions rather than profits or cash flows. When you had this in 99, you had this rush to IPO, 2-3 companies every single week IPOing. And when they were reporting earnings, it was a focus on the amount of eyeballs, the amount of clicks, the amount of daily users they were getting, how many page views they were getting. That was the big focus. Those were the new metrics that you had to think about. We will monetize this in the future. But right now, it's a fight for as many eyeballs as we possibly can because we got to get more eyeballs than the next website. And investors went along with that, saying, yeah, we have to think about this in a new way. Investors may focus on unconventional metrics, overfunding and overvaluation. Early capital leads to a proliferation of startups and IPOs, many of which are unsustainable. We haven't had that yet, but we are starting to see the IPO market heat up. You had VC push a lot of money into AI companies. I think that's pretty much all they have in their portfolio companies right now are AI companies. So you can hope to be acquired by a larger company or IPO. Once you start seeing 1, 2 a week, 2 to 3 a week hitting the IPO market, let's think sometime September, October, you got a really hot IPO market. We're in that phase. You're in the overfunding and overvaluation. Market correction, when expectations outpace reality. A sharp correction or crash can occur, wiping out speculative excess, but leaving behind the strongest companies and real innovations. And you have your historical example with the .com. NASDAQ rose 400% between 95 and 2000, with some stocks gaining over 2,000% in a single year. Many companies with little to no revenue received massive valuations. Crash saw the NASDAQ fall 78% from peak, and many companies failed. But the internet as a technology ultimately reshaped the global economy, and I think AI will do the same thing. Parallels here with current AI, parallels include soaring valuations, speculative investments, and a rush of capital into any company branded as AI first. Expert notes that while AI is transformative, the current hype may be outpacing real-world adoption, and a correction is likely to separate sustainable businesses from those built on hype. So that was sort of a nice overview. Look at this. I love Perplexity because of this. You have all of your sources in here that it used. So you can go to all of the sources and check them. And even with each statement, this is from source 2, source 3, source 9. I didn't have to click on a whole bunch of different sites to try to compile this. And then it starts giving me interesting searches down here. How can I identify when a stock market is at the peak of inflated expectations? What signs indicate a market is entering the trough of this disillusionment? So it continues on with my theme, and I can keep researching this without having to search. If Apple doesn't buy Perplexity, and Perplexity doesn't just have the app, It has a browser. You have Perplexity Labs. I have a subscription to Perplexity Pro, so I already pay them for the use of their product. If you haven't used Perplexity to do a search instead of Google, use that. That being said, I'll leave you with this thought. What is the value? Once you start using this, ask yourself, what is the value of Google search? And all of the revenue that's tied to Google search. What is the value of Google search when I can get this, and if I want to, I can click right on the link and go to the link. I don't even have to use Google search for any of this. Okay, S&P. We are now on a new forward 4-quarter operating earnings cycle. We're flipping over to Q3 25 to Q2 26. So earnings expectations always do this. If you look at them every quarter, they're just higher. So when the front one falls off, the back one adds on. So you do notice a jump. We go from 269 to 279. Even though we have no results yet, we are in earnings season, so we've jumped forward. 62.79 on the closing. You're 22.43 times forward earnings, and we've just added the fourth quarter and gotten rid of the front month versus 22.9. If we use last week's earnings, because we haven't even had any results yet, if we just use last week's earnings, we would be at 23.29 times forward earnings. All right, and that means that we have exceeded the last valuation metric of 23 times. That was the last high. Not only are we printing all-time highs on the index, we would be printing a new high on the forward earnings for this particular cycle, but we're 22.43. Let's see if we can take out the 23.29. Look at that. Not only that, but just now we're getting this thing going on. This is why I say we're entering the hype cycle, because the market just doesn't seem to respond to any fundamentals. It is being dragged ahead by this star, by this AI star up here, which keeps rising. And valuations are rushing to try to keep up with that rising star. Triple Q, all-time high, 556.22. IWM, 223.08. Out of correction territory now, only down 7.8%. And IJR at 113, down 10.8%. IJR are all profitable companies. They're all profitable. IWM has about 35 to 40% unprofitable companies. And somebody had asked me, if you take all of the companies in IWM and you look at their forward multiple, it is higher than S&P. But the price on here, 223, well, actually that's not the index, it's just the ETF. If you just took the profitable companies and looked at the price of the index, just with the profitable companies, which are about some 1,100 companies, 1,100 to 1,150 companies out of 1,800 and something, you would be at about 17 times forward earnings if you just took the profitable companies for the price that you're paying over here. So this price represents this, and what I'll do is I'll throw in the unprofitable ones for free. That's why IWM represents such a great value right now, because you are getting all those unprofitable ones for free. IVP slightly higher, 13-week at 8% versus 0% last week, so it is a little bit higher. We're sitting at 13.283 on the last implied volatility. Considering everything that is going on, we should have more volatility, but we don't. There seems to be a combined lowering of fear. While there is an increase in fundamental uncertainty, the market is saying no, that actually means there's less fear if there's higher uncertainty. So it cannot be looking at the fundamentals. It cannot be guided by the fundamentals, because it wouldn't be responding the way it responds. And it cannot be just simply saying, no, we disagree with everything, we're pricing in perfection all the time. It cannot simply be that. There must be something else, some form of gravity dragging that index up. And I think that is our AI hype cycle is one big giant black hole way on top of the market, and gravity is just sucking valuations to it, because the future is whatever you can imagine it to be. There is no limit to the stories that you can make up. And because of this, after the results were released Friday for non-farm payrolls, I saw the 74. I immediately shorted futures. I shorted yes. And what happened was you had this jump up. I shorted futures and it came down and it did this. And I thought, you got to be kidding me. That's it? That can't be it. And it started to rise. And I said, okay, I'm out. Get me out. I don't care. I can't stick around anymore. So I closed these futures. Didn't lose anything, but didn't make anything. It pulled back so little. I was watching it going, well, come on. Everyone should be catching on now. Only 74. Look at the healthcare. They created 58, so the economy really only created 16. This is not a party. This is a wake. Come on, and it wouldn't do it. So I am short beta with SPY, and I am long beta with IWM in a way that I am net positive beta still. I covered those off. I just said that's enough of that. And I've got a small position left in IWM where I am long beta, but it just kept reminding me of 1999 and how ridiculous things got. Now, I don't know if we're going to get that ridiculous again. It was 26 years ago. I think that most of the people in the industry at that time, if you take the 35 to 45 age group, which predominantly are controlling a lot of the money in investment funds, are today 61 to 71. Maybe many of them are retired, and maybe many of the participants in the market today did not live through that hype cycle and would not recognize it, or are unaware of it, or this time is different. And that we are destined to repeat the same hype cycle for the .com as we repeated for canals, as we repeated for railroads, as we repeated for radio and television, as we repeated for electricity. All the new technologies that were general purpose all did this. Massive investment, hype cycle, and then bust. All of them did this. Are we destined to repeat that again, or is the market sophisticated enough to say, whoa, we've seen this movie before. We're not going all the way there. Maybe we'll go to 24, 25 times forward earnings, but we're certainly not going to go to the 300 times forward earnings that NASDAQ had at its peak. I think it was some ridiculous number. I can't remember if it was like 150, 200, or 300 times forward earnings. It was ridiculous. But we were all told at the time, and everyone bought into it, that earnings are not what matters in this new economy. It is clicks. It is page visits. It is eyeballs that matter. The revenue will come, but we need the people showing up here first. And look at the growth in the eyeballs. Look at the growth in the clicks. Are we going to fall into this trap here where it is average monthly users that matter? OpenAI claims to have, 800 million active monthly users. 800 million, up from 500 million, up from 400 million, up from 200 million, up from 50 million. Wow, look at the growth. That's incredible. I need a piece of that. Here's my money. Gemini has, 250 million to 300 million? Now, some of those could be overlap. You could be using OpenAI and Gemini at the same time, so it's not like you can add them all up. There are probably globally, over 1 billion people already that use, and I'm just talking about learning and reasoning models right now. I'm not even talking about all the other stuff. Over 1 billion people that use this. That is massive growth, and we may be distracted in thinking that's what matters because that's going to turn into revenue at some point. Look at that. It's going to change everything, and that story will get bigger and bigger and bigger. Will the market follow along with the story and repeat history yet again? Or will the market say, we're not going there. we'll go this far. We'll go to 25 times forward earnings. That's about it. We'll go this far. Maybe 26. I don't know. What is going to be the giveaway is the pace of the IPOs. Watch for that. When you start seeing 1 a week, 2 a week, 2 will turn to 3, 2 to 3 a week, 3 to 4 a week. That's when you should be very, very cautious about when it ends. I'm not saying you can't invest in this. It's everyone thinks that they're going to get out before everyone else. Oh no, I'll know when to get out. Nobody knows when to get out because you get volatility with this. And over the last little while, we've had this kind of thing. Buy the dip. Buy the dip. You have these V-shaped recoveries on everything. V-shaped. Until you get the last one where it dips and somebody buys and it keeps going down. They say, well, the V is just going to be longer and it goes down. Well, the V will just be longer. Let me buy more. And they get wiped out. That was 2000. Some people were late to the game. I remember one person mortgaged their house to buy a whole bunch of one stock after watching this for a whole year of these stocks on IPO at 100, ending the week at 350, and thought, well, I'm going to make a lot of money really fast, and it never recovered. And they never got out, and it never recovered. No, it'll recover. No, it'll recover. And it was all gone. It was all gone. So was the house. I don't know. This is an interesting one. I do see the hype cycle starting. I do see all the money that has rushed into this sector. There are literally thousands of companies around the world. If China's investing in this, how can we not invest in this? We need to invest in this. In fact, we have to get rid of all AI security because China doesn't have AI security. And this many jobs will be eliminated. Oh, it's going to create this. And oh, everyone will be doing what they want. It's going to cure poverty. Poverty will be gone. Like these stories will just keep getting bigger. And you'll start thinking that most of it sounds good. Oh, that maybe it is real. And the valuations, this is so cheap right now. Then suddenly a company will have a $4 trillion market cap. And no, 5. It should be 5 trillion. And then why not 10 trillion? You know, they'll be the first $1 trillion company that started in somebody's basement with AI agents. And you'll think, well, that sounds logical. And all of it is going to change its trajectory because with the S-curve, we're here. And it looks like you could do this. And you're extrapolating here without realizing that all of them do this. All of them. It's when this distance gets too big that you cannot justify this anymore, it comes right back down and tends to undershoot. I don't think we're there yet, but we are at the early stages of Mr. Market holding its balloon and blowing it up. Already with a few deep breaths in that balloon already. So I would be very cautious on how long a holding period I think makes sense. But I do think there's probably more upside before you get downside. 3 companies, we got total agreement this week. Total agreement. ConAgra from Consumer Staples, Delta from the Industrials, and Progressive, an insurance company here from Financials. And they're all reporting on Thursday. 3 companies. And then the week after, we start with the banks. On the next screen, we'll end on the next screen. On the next screen, I'm going to give you a list of what, based on what I've seen over the last couple of weeks, what really matters to the market today. Okay, on this screen, I'm going to present what really matters or what seems to matter to the market. As you can clearly see, there's nothing on the screen. Nothing matters.